All right, we're good.
We're good, guys.
All right, looks like we've got Rowdy jumping on, so I'll give him a half a second to get loaded up here.
It's connecting.
Ian says it is connecting to audio, so I don't know, maybe you can hear us, maybe you can't. What you eating, Austin?
I'd say go for it, Jeff.
All right, sounds
All
good.
right.
Well, if you can't tell, we're going to be pretty casual through all this. I found in presentations it's a little easier just to have conversations than to give you a bunch of data points and kind of nerd out on the economics and stuff. So ask questions, get involved. If it's something that you have a question on, somebody else next to you has the same question, we're all casual here. We'll all be friends, no big deal. A couple housekeeping, we're going to record this, obviously, if everyone hadn't heard that already. So keep the vulgarities to a minimum and don't take your shirt off. If you have questions, raise your hand if you don't know how to do that. I'm sure Levi can, or Dustin, one of those guys can teach you how to do that. I'm not entirely sure I know how to do it on Zoom either, but you can also just do this and we'll figure it out, right? Pretty easy.
Fair enough.
I also mentioned earlier, I'm not comfortable on Zoom. I very rarely, oh, Josh is trying to come in. I very rarely work on it. So if I have technical difficulties, sharing screens or PowerPoints don't pull up right, or give me a little grace. Fair enough.
Fair enough.
All right. So the first thing we're going to say, if you want any information, you want to get on our list of investments. Well, actually, let me back up a little bit. I'm Jeff Sheeman. I'm partnering with Brian and Brooke here. Brooke's under Brian's name on Zoom, and Brian's just a host. So Brian and Brooke are husband-wife team that started FIG, Fundamental Investment Group. Starting syndicating is the idea. We've all invested in multiple sectors over the years, and they've got real hot and heavy in this oil and gas stuff, and they brought me along. I'm not terribly experienced with the oil and gas like they are, but my day job, I'm a portfolio manager for a pretty large bank here in Southwest Missouri. My book currently is about $140 million in assets under management. So that's going to be my expertise, and my team contribution here is dealing with investors and managing the money. The actual investment stuff, some of the stuff I'm learning as I go too. There's a lot to this oil and gas stuff, a lot more geology than anyone would have ever expected, I would guess. But so all that to say, if you want to get on our list, we're going to be sending out emails for future projects and where we're at on current projects and things like that. It's www.investfig.com, INVESTFIG.com, like a fig Newton. Okay.
I'm dropping that in the chat right now.
Perfect. Thank you.
Yep.
You can get on there, and the website's got some minimal information there about all of us and our backgrounds and what we've invested through over the years. And I'll tell you, my experience is more in market-based investments. I've invested in the market in various forms over the last 15 years, and Brian and Brooke are polar opposite of me, which is kind of interesting. They've done alternative investments and never done the market type stuff. So it may be just a little bit of market stuff. I say never. Brian's nerded out with me on some option stuff before, but it's it's pretty interesting, the dynamic we have. So with that saying, I'll get into it. This is going to be a very overview of why we like oil and gas, why we're going to invest in it, why we're kind of doubling down on it. There's going to be a lot of stuff in here that you might not know, might not have heard of. Some of it matters, some of it doesn't, right? If you have questions, raise hands. There's a lot of cool stuff about mineral rights and how oil and gas works. So I'm going to try and share my screen now to get over to the PowerPoint. So let me know when you guys see it. You should see the logo on the front and says InvestFig top left. Can you guys see that?
Yes.
Yep.
All right. All right. So there again, there's our. Sorry, I just switched it. There's a invest.fig.com. That's our logo. So we're going to dive right into mineral rights. So mineral rights are the rights for what's underneath the surface, right? So we're talking the rocks, the oil, the gas, the water, the whatever, everything that's underneath the surface of the soil. You can read the slide there. They're different than surface interest, and surface interest is land. And I'm sure as real estate guys, you guys all know that and have some understanding, whenever you can purchase and lease land, right? This is the same concept. Mineral interest, and I was leading into that, interest and surface interest are severable. So somebody can own the surface and somebody different can own what's underneath. Brian mentioned in one of our conversations that Donald Trump had maybe written a book and he had purchased air rights over someplace, probably to prevent a skyline or a large building getting put in place. But it's interesting that two different people can own two different parts of what I would consider the same property. Another thing that's important about this is the mineral rights are more important. They're subservient or servient to the surface interest. So the guy that owns the land on top is less important than the guy that owns the mineral rights. And when you buy the mineral rights, there are implied easements to access the mineral, right? So you buy the mineral rights underground because you're going to drill for oil. We'll call it Levi, he's the farmer. Levi owns the surface interest, he runs cows on top, and then we buy the mineral rights down low so that way we can drill for oil and gas. He has to allow us a road or access to access our mineral rights, to access under his ground. So he is in second position, we'll say, as far as lien holders go. He's in second position, if that makes sense. The U.S. is one of the only countries that have private ownership of mineral rights, which is pretty cool. Makes us, I don't want to say a monopoly, but there's a lot of countries out there that produce oil, but the way we do it is why we've been a world leader in the oil industry for a lot of years. And I don't see you guys to see if there's any questions or anything so far. So if there's a question,
I'll let you know if anything comes up, Jeff.
Someone just pop up because I slideshow. All right, so we went through implied easements. The interests are severable. Surface interests are less important than the mineral. When we get into actually drilling for oil or gas, they're called leasehold interests or working interests. We are working to develop the oil, to drill the oil, right? So there's, just like real estate, there's a million different business models here on how and who makes money, right? You can be a wholesaler and buy really foreclosed on houses or really rough houses and sell them to you guys, where you guys can rehab them and flip them or turn them into rentals or whatever. Same kind of thing goes for oil and gas. You can buy the surface interest of the land, you could buy the mineral rights, then you lease it out to what we call production companies or exploration companies. There's business models where we drill for oil and find it. There's business models for when we found it. There's business models for when we cap and abandon. There's, depending on anything else, your risk tolerance kind of determines on what part of the oil industry you want to be into it. So a lot of times these land guys, they'll go out and they'll buy oil or buy the mineral and surface interest. They'll buy the land and then they'll lease it out to exploration companies. And that's kind of where Brian Brook and I have kind of fallen into. We like the exploration part of it. It seems like the return's a little bit more substantial and comes with a little bit more risk, right? Because we don't know that the oil's there yet until we stick the straw down and find it. But that's kind of where we're going to talk about. So these working interests, they can be sold, they can be leased, whatever, just like anything else. Once this company leases it, so this exploration company leases it, they will do what's an AFE, which is an authorization for expenditure. Basically, it's a line item list of all the costs that they think are going to be associated with drilling the well and then completing the well. And then they go through a lot of geological data, which is pretty cool, on how they estimate the reserves. The EUR, they call it, the estimated ultimate recovery. And so they'll get an AFE, say it's going to cost this much to put this type of well in there. They'll get all their geological data saying, we believe there's oil at 8,000 feet. It has this resistance we think there's this much gas, this much oil, maybe this much propane or whatever it is. And then they estimate their income from it, how much they can make. And obviously if it works numbers wise, it works. And that's kind of where we're at. These leases are kind of interesting in a sense that they're different than some of the leases that maybe you guys might be accustomed to. You know, a lease in today's world with real estate, it's you have a tenant, they lease the property for a year. At the end of the year, we renew it or modify it or dissolve it, right? It's a timed element. A lot of these leases in oil, they have a production clause. So they'll have a lease that says, you know, Levi will have the working interest in the mineral rights for XYZ land so long as he starts producing oil within 3 to 5 years. If he doesn't start producing oil, it can revert back to the owner of it, and then they can find another exploration company to try and do it. The opposite side of that, which I think is even more interesting than the first part, is once production starts, these leases last until production stops. So you get your mineral rights, you get your lease, you get your exploration company lined up, takes you a couple of years to get all that done. You start drilling for oil. If you hit oil and find it, you can have that lease for 20 years. It doesn't stop until production stops, which I thought was really cool. Next slide, where are we at? Mineral leasehold. So with that being said, I told you there's a million ways to skin this cat on making money with oil. The share of revenue that the mineral owner gets, which is who we are, who FIG is going to be, we're going to lease this to produce oil on it, blah, blah, blah. There's a percentage, and it's called net revenue interests. So whenever you have a well that produces $100 billion or 100 billion gallons of oil or barrels or whatever, there will be a percentage carved out for everyone above us. So the guy that owns the land, he might own the land and sell, you know, his share of the mineral rights or a portion of it. Say, I get 2% for everything that you pull out of my ground, right? And a lot of these guys operate on percentages as opposed to a fee. You know, like you hire a consultant for $10,000 to come and tell you how to do your business. These guys, you know, the geologists, the landmen, the surveyors, all those people will not necessarily take a fee up front. They'll take a percentage on the back end and say, you know, I want 2% and I'll do my service for that. Well, you add all that up, and a typical deal is somewhere between 70 and 80% of net revenue interest. So that's what we're looking at, is the net revenue. Everything above that we don't get. So if it produces $100, we get $80 of it, and then we divide that up between the investors, how we've got these things structured. I don't know that there's anything, a royalty might be a good word to use there, but everyone's familiar, I imagine, with royalties. So there's also overriding royalty interest, which really is kind of what I just explained. There's sometimes, like for example, me and Brian are working on a deal right now, or looking at a deal that has it was a 74% NRI, but when you actually get into it, the guy that's selling us the deal wants to maintain a 1%, so it's only 73%. So that would be kind of an overriding interest. It's just add it all up, but it's supposed to be in the net revenue interest, the NRI, but this guy didn't include it in his for whatever reason. So you gotta be aware of that and pay attention to it.
Another interesting part there with those overrides is like, so if we buy into a project, we drill a couple wells and they present us with an AFE and we look at it and we say, hey, we don't really want to be involved in this particular well. We can turn around and sell that AFE to someone else that wants to be involved, and we could carve out a small override within that deal to still participate in the well, but not have to front any of the cost up front. So there's lots of ways to do these things, which is it for us. It's fun to figure out.
And it gets complicated, and that's where we try to come in and really overanalyze these deals. You know, a lot of people don't invest in things that they're not comfortable with. And, you know, here in Southwest Missouri, we just don't deal with a whole lot of investors that know a lot about oil and gas, you know, and I want you to invest with us. I want you to bring money, and so I need to educate you to a certain level to make you comfortable with it, which is why I say this needs to be a forum. We need to have conversations. You need to ask the questions. There's a lot of this stuff when I was learning, I had no idea, the geology of it, and there's no other way to once you actually understand it to look at it, there's no other way to factor this. Like, it's all geology. Because you're drilling into the ground at multiple depths trying to extract stuff from it. So it's just interesting to me. But anyway, we'll move on. So this, there's a couple different types of wells whenever we drill for oil and gas. The one on the right is what's called a vertical well. That's what we've been doing for 100 years. That is the most overused, most common type of well for a lot of years. It goes straight down into the earth. If you look, they have all these layers are called formations. So different layers of dirt, rock, sediment, things like that throughout it. So what they would do in the past, and I don't know if you guys can see my mouse.
We can barely.
Okay, well, on the right side, this vertical well, so we would stick a straw, we'd stick a pipe way down into the ground. When you get to the formation part of it, kind of where on the left side, this thing turns to the right and moves over, that's what they call the formation. That's where they found the sand, where the oil is, or the sandstone rather. That's where the oil is. So they'll drop down a charge, an explosive, a shotgun shell, something. And that's beyond my realm of understanding. And they'll blow a hole in the side of this pipe, and they will extract whatever oil is in the vicinity of this pipe. And that's the vertical well. We've done that for a lot of years. It's proven, it's cheap. We like vertical wells. They're good, but they're limited because we've been drilling for oil for a lot of years, and our production peaked in 1970. And you'll see that here in a slide pretty soon. So we have to reanalyze, or we had to figure out a better way to do this. And insert the left side of the screen, which is the horizontal well. So instead of just going straight down, they went straight down and then made a 90 and went through the formation, which went all the way through that rock. So instead of just getting the little bit of oil that's around the pipe that on the vertical well, they do these horizontal wells for miles. It'll be, they'll drill down 8,000 feet and then go 2 miles, 3 miles, one way or another. And this is where fracking comes in. And fracking is fracturing the formation. So that's how I can remember. Fracking is literally breaking the rock up. You inject this fracking fluid to increase the pressure so much in this formation that it squeezes the remaining oil out, right? And so then it goes out, they suck it out, they separate it back from the fracking fluid to the oil. But that's I don't want to call it a byproduct, but we were forced to figure out a way to extract more oil based on our consumption and our supply diminishing. We had to find oil better. We knew it was in this formation because we did it with a vertical well, but instead of just getting a little bit around the pipe, we had to go all the way through it. Okay, I don't know that I can talk that anymore to death, if that all makes sense to you guys. So these next things are, I don't want to get too crazy deep on the, I don't want to nerd out too much on all the data on this. Everyone here knows that you can make charts say whatever you want them to say, right? And what we're looking at here, though, is our natural gas consumption. What's important on this slide is the most recent thing. All of us are young enough to realize COVID and remember it, and we're still dealing with the aftermath of that. But if you look at 2020 and you go straight up when COVID happened, that's barely a blip in the radar, right? We shut the world down, not just the United States, we shut the world down, and our gas consumption, it's a rounding error. We barely dipped on gas. We're going to need gas forever, right? It's just the thing. Then you look over to the right, exports, we've been exporting. I mean, if my portfolio went up at a rate that natural gas exports, I would be a very rich man, right? but our portfolios don't do that, unfortunately. So all that to say that we're going to use gas for a long time, and we're continuing to use a lot of it. The next slide here, and this is what I was alluding to earlier, where oil supply peaked in 1970. When you're looking on the left side, you see the green, the conventional lower 48 states. We peaked in 1970 on the production of oil. So then, as you can tell, the yellow, we started looking at Alaska. The blue, we started looking offshore. When we started fracking, and I was telling you about those horizontal wells, that's that red, that's the tight oil. So our supply was diminishing, our production was diminishing. We were forced to figure out a way to find oil. And so, Brian will go deep into the price of that, in 2008, he might have to correct me here, but in 2008, the price of oil was $147 a barrel, I believe. If you fast
That's right.
forward that and add in inflation up to now, that'd be close to $200 a barrel of oil. Right now, oil is trading at like $70, $74, $75 today, the WTI crude oil. There's a lot of room to grow in oil. There's really not a lot to say that. What's going to happen next? This dip forced us to learn how to frack, right? So when it dips again, what are we going to learn then? And because we have to have oil, we have to have gas to operate. And you'll see that here in a slide in a second. The slide on the right is it's the Permian Oil Basin down in Texas. It's declined. The ultimate recovery has declined. So really what we're trying to paint here, and I'm a Southwest Missouri guy, so I'm a little bit more layman than some, but we're saying that we're going to continue using it. Demand is going to stay constant, if not increase, right? Because I showed that in 2020, when we shut the world down, demand barely dipped. So demand's going to be there. Our supply is kind of diminishing, right? We've got to figure a way to produce this better. What supply and demand, basic economics, that's going to increase the price, right? And right now we're at $75 of oil. We should be at 200. Anything over like 50 makes a lot of money. So we'll get into that too. This next slide here is that WTI price I was telling you about. That's what we follow in the stock market on the price of oil per barrel. Any of these gray areas, that's a recession, right? So you had the 2008 financial crisis. We had the COVID dip, which is almost really an outlier. You almost shouldn't actually include that, but we do. But what's interesting is after these recessions, there's a pretty strong increase upwards, right? And I don't know if any of you guys follow the stock market. I would suspect you do, but they've been anticipating a recession, and we could all have the argument: are we in a recession? Are we going to be in a recession? We're kind of changing the definition of what a recession is as we go here. It used to be 2 negative quarters of GDP in a row, and so you were 4 months into one before you even really knew if you were starting to be in a recession. Well, hell, we've had 2 negative quarters now, and jobs, I don't want to nerd out on that, but jobs is kind of the hiccup there. But so they're kind of changing their definition of a recession right now. And I don't know, all that to say that when a recession happens, oil price in the past has gone up. Obviously we can't predict the future, but it seems like a good time to buy. Same thing for this Henry Hub natural gas spot price. There's a few different hubs where natural gas gets funneled through pipelines that purchase and sell gas. Henry Hub's one of the biggest. I think it's in the top 3, if I'm not mistaken. And that's what you'll see in the stock market when you look at natural gas price. It was like $2.40 or something. Historically low. It is extremely low for natural gas right now. Which, what does that tell us? Does that tell us we need to invest, or does it tell us that we need to be scared of it, right? And I'd say any seasoned investor, whenever you can buy something at such a huge discount, and actually, here, let me go to this next slide before we, Josh, what do you got? I see Josh Masiga raised his hand.
I think that was a mistake, maybe.
Okay.
Yeah.
Okay, perfect. All right, so this next slide, going back into it, it wasn't that slide. Where was that other slide? Oh, maybe it is this slide. So, anytime we talk about market-based investments, you say, oh, well, the stock market's in a correction, it's 20%. So you're buying everything at a 20% discount. If you look at these prices of oil and natural gas and where they're at pricing-wise, they're at a discount right now. So now might be the perfect time to buy in, because oil and gas can't go much lower. I mean, oil can, and we saw oil go negative there for a little while, but something like this, we need it, and so prices are going to go up. This next slide here, and this is for all the people that believe renewables and solar and wind and nuclear are going to be the saving grace, and they may be, not in our lifetime, not in our kids' lifetime, probably. This is our energy production by source. So traditional biomass, that's wood. In some of these underdeveloped countries, they burn poop. You know, so they burn. Then we have full oil, natural gas. That little bitty sliver up there at the top, which is like 3%, is everything else added up, right? So you've got your solar, wind, hydro, nuclear, gas, or not gas, hydro. And that's a terawatt hour over there on the left, which is an astronomical number if you ever add all the zeros up. But what I'm saying is we're not getting rid of oil and gas for a long time. Oil and gas is at a low right now. We can get into it, and the upside seems pretty great. You know, a lot of people have figured this out though, and so finding the right deal is challenging, and that's really where Fig comes in here. You know, and I didn't dive too deep into everyone's backstory here, but we've invested in over 100 oil wells at this point. I'm sure Brian could give me the exact number at some, you know, if he looked it up or just knows it off the top of his head, but over 100 different oil wells. You know, if you need to produce concrete, that takes natural gas. If you need to produce these wind turbines, that takes oil. You know, the fuel market, diesel and gasoline, is only 25% of the oil market. So we're going to need oil forever and ever. Very experienced in oil and carbon capture technology and things like that. And we've all kind of evolved to oil and gas. You know, I told you I was more market-based investments. Brian and Brooke were more real estate and farming. And then you start dipping your toe into oil and gas, and over the last few years, they've been redirected, right? You follow where the money is, and now we're seeing oil and gas at a discount. It just seems like a no-brainer to us, but not everyone's comfortable with it. So that's why we're here to do this. And then the next thing, you know, I don't know if any of you saw the Chiefs win the Super Bowl, but the Hunt family, I don't know if you can read that top slide there, but it says $15.5 billion is what they're worth, and their investments are in oil and real estate. So we're the guys, right? You're the real estate guys. We're the oil guys. And it's important to know here that when you do oil, you know, everyone does real estate for the tax advantages, right? You're not going to get rich fast in real estate buying rental houses and apartments and stuff like that. You're going to get $100-200 a door. It's a get rich slow scheme. Great scheme, works, tried and true, proven, right? Like nobody can argue with that. Oil is also considered real estate. So you can even 1031 into oil, like what we're doing, right? You can 1031 into it. And actually oil and gas have better income tables, the way that the taxes treat them, they're actually better than literally anything else. Mineral rights have their own little clause in the tax tables and how they're treated. And it's, so you not only make money on the front end by the income the oil and gas produces, but you also save money on the back end with your taxes. And I try to stay in my lane. Let me get out of this here so I can see you guys again. All right. I try to stay in my lane when it comes to taxes, right? You don't ask your attorney for tax advice. You don't ask your tax guy for legal advice. So if you get into this oil and gas stuff, you absolutely need to have an accountant, and we have some that are comfortable with this and we can share with you. But it's cool. You make money on both sides of it, and it seems to be worthwhile anyway. So I guess what questions have we uncovered so far? Where are we at? What are our thoughts or feelings? You guys ready to write me a check?
Love it.
So what funds do you have right now? What's your barrier of entry cost to one of your guys' funds?
You want to take that, Brian, or do you want me to?
Yeah. Oh, yeah, I'll take it. So at the moment, we don't have anything that we're offering currently. That is, we're analyzing deals right now. And it's going to vary deal to deal. Typically a unit in one of our deals is going to be about $100,000, approximately, you know, but we can divide that up. We don't necessarily have a minimum per se. It just kind of one of those deals when somebody buys a unit, they do get first crack at it though.
And so when you're doing a unit, is that on a 100-unit basis or?
It just depends on how much we're raising. It wouldn't necessarily. Oh, I don't know how to say that. each unit wouldn't necessarily dilute the others, so to say. We would just buy a bigger interest in the well. So they're kind of open-ended funds generally.
Okay.
So yeah, I'll speak to that for a second. So what we're doing is we're accomplishing purchasing power, right? The guys, these producers, these exploration companies give different interest based on how big we invest with them, right? Just like anything else. If you bring 5 million to the table or 50 million to the table, the guy with 50 million is going to get a better deal. And that's what we're trying to accomplish here. You know, we've invested at your level a bunch of times, right? You give them 100 grand, 200 grand. You sign up for a loan, because there's times we'll use leverage on this. We'll do 100 grand in cash. We'll make you a general partner, do another 100 grand. That way you get some leverage in the deal, and we can actually put 200 to work for each person. There's lots of ways to structure this that we've done. But we want to get a bigger seat at the table, right? And that's the goal of this. We get a bigger seat at the table. We know what your deals that you're going to be looking at as individual investors, because that's what we've been doing. So we can beat that because we know what it is, but we can still make more by getting a bigger chunk to these exploration companies is the idea. And, you know, Brad and I've been looking, and Brooke too, about we went to Texas, I don't know what, a month ago now probably, and we sat down with a lot of different exploration companies trying to find the right deal that we liked. We came back with 4 or 5 of them, and one that just really, really looked good. And we really thought we could make it work, and it was very low risk and still had some meat. And we've been analyzing it for about 2 weeks now, and kind of came to the decision yesterday that, you know, maybe it just wasn't going to work. It wasn't the right deal for us. It just felt a little too skinny. And so Brian politely declined, and what do you know? Now they're knocking back saying, well, what do we have to do to make it work, right? And when you come with a bunch of money, you can negotiate these things, right? You can make them a little bit better deals. It may still not work, but if they're willing to move our NRI from 74 to 79, maybe it works now, you know. And we really like that deal because and I don't want to pitch you it because I don't know that we're going to do it at all, but it came with a classification of being de-risked. And anytime anyone says an investment's not risky, you need to walk away. There is nobody in the world that can say that. But think of it more of a oil and gas classification. So we've been drilling oil forever, right? 100 years, and we've got all the cream off top. We've got all the easy stuff, right? We've found all the 3-bed, 2-bath, good neighborhood. We found all the easy stuff, right? So now it forces us to look somewhere else. And that's where all this geology comes into place. 100 years ago, they could stick a pipe in the ground and find oil, probably. Now we have to look at seismic data. We have to look at 3D maps. We have to look at fault lines, property ownership. I mean, all kinds of stuff to find, okay, there's a little pocket of oil. Now this little pocket, it's 1 billion barrels of oil. Makes all of us really, a good investment. Probably not big enough for BP or Exxon or whatever, because that's something that I've come across as far as some questions that are good that if you guys have thought of, great. If you haven't, I'll go ahead and bring up the objection. But why isn't BP and Exxon and Mobil, why aren't they doing this? And they are. The answer is they have billions of acres of land under management, and they're not really in the exploration business. They have oil. They're producing oil, right? We're in the exploration business, and Brian has a stat that, what was it, 85?
So those guys, they're almost more in the refinery business. Like 80% of the oil that's produced domestically in the U.S. is by companies with 13 employees or less. So most of the domestic oil and gas is produced from smaller companies.
Yep. And so when you already have billions of acres of oil, you don't go looking for the little pockets of stuff anymore, right? And that's what we're doing. And I was in the car business for a lot of years, Chevrolet, Ford, they make money, right? The Chevrolet Ford dealers at the smaller level make money. The small buy here, pay here lots, they make money, right? There's secondary and tertiary markets for all of this stuff. And sometimes what we're looking for isn't big enough for them, but it's more than enough for us, if that makes sense. But anyway, so we sat down with several of these guys and we actually hired a kind of a famous geologist, which was almost a double-edged sword. He was really intelligent. He could really dumb things down for us, so we understood the geology of it. But he got recognized by like half the people we talked to. And so then they turned into like, hey, Art, what do you think about this oil and gas price? What do you think, this is going to do to the market? And so we'd be paying for his time to sit there and visit with his buddies. But it was also good because, he gave us a lot of clout and credibility just by showing up, by being there. But we sat down with all these guys, and this oil and gas deal, the first one that I was going to tell you about that's de-risked, they already have oil wells in the formation or that's hitting this gas well. And so they know the gas is there. So it's not so much of a de-risk that the investment isn't risky. It's de-risked in the fact that we know there's gas there. Like, we know it's there. It's not a finding it issue. It's now we know it's there. Now we have to produce it cheap enough. We have to extract it cheap enough. And it comes with its own set of problems, with that going. But that's true with anything, right? Any investment, the less risky your investment is, the less your return is typically, right? And so that's kind of where we're running into a rub here. They need, I don't know how many wells they're going to drill. It was like 40 or 50 wells. You remember, Brian?
Yeah, potential for 40
wells, right? But they want to make as much money as possible. They want their margin as big as possible, and they need our money too, right? Everybody, they want to use other people's money to make it work. So we have to make it make sense for us too. And we voted it down, and now we might be going back to it, which is cool. It's good to see somebody, to have that feeling, and I'm sure you guys have had that before. And if you ever start syndicating, when I talk about my bank life, I'm a very casual Southwest Missouri guy, so I hate being but I manage $140 million through a bank here, which isn't a lot of money, right? Especially in the grand scheme of things. But when I'm talking to somebody about investing $100,000, or I tell them I have a book of $140 million, their stance changes, right? They just change the way they react to you. And so that's what we're trying to do with FIG and have some purchasing power.
When you purchase a unit for 100,000, is that a diversified, or is it tied to a certain well or project?
Great question.
So
go ahead.
Go ahead, Jeff. Sorry.
I was going to say, it depends on the project, really. A lot of the times and that's something Brian and I have been toying with, right? With doing 3 or 4 wells per deal. This first one, the gas one that we're talking about, is one company, multiple wells with one company. So not necessarily diversified. It's still just in gas and only one company. But that's where we run into a little bit of a rub with this. These oil things have to be repeatable, and you have to have a big seat at the table to get it with the big companies to make them repeatable, right? So this 40 well deal, that'll be a 20-year deal, and we may never need to invest in anything again. Or we do 3 smaller wells, and then we're diversified through 3 companies, but we're all still in the oil and gas. So I don't know that diversification is had inside of oil and gas very much. And maybe Brian can speak to that a little differently. He's a lot better with the macroeconomics of stuff.
I think she's asking a different question. And so like this particular gas deal that we're contemplating, that $100,000 would be split up over 4 different wells. So you wouldn't be stuck to just a single well, if that's what you were asking.
Okay.
What else you got? I know you guys have more questions than that.
So looking at the financing portion, so we're talking about 1031 exchange into the fund. Any chance of a self-directed IRA investment in this as well? How creative can you get?
There are some ways to do that. The concern I would have there would be the UBIT taxes. I would have to visit with some folks to figure out how to do that, but there is a way to do that. I think the best way would probably be through like an EQRP type thing. And I can send you some information on that.
Okay. And then leveraging, how does that look? So you talked a little bit about $100K investment, and then actually borrowing some money. How does that work?
I mean, it would be just like borrowing money for a rental house type thing. You know, as a limited partner, you don't carry any risk associated with that debt. Now, if you're a general partner, there's potentially something there, but generally we like to do these things 100% equity if we can, just because, you know, there's potential that things do go wrong. You know, you have a drilling failure or something along those lines. So though the only time we would take on leverage like that is on something that we're feeling extremely confident in, and not that we're not confident in the others. It's just, you know, leverage, I look at it as a chainsaw. It's a great tool. It can speed things up, but if you're not careful, you cut your leg off.
Okay. What areas are you looking at right now?
Currently we're looking at some stuff in New Mexico, which that's that nat gas stuff. The nice thing there is most of that gas is sold to California, and California pays a premium because they, you know, want to cut off their nose to spite their face type thing. And then we're looking at some stuff in Texas.
Okay.
That was the other appealing thing to this deal. You know, natural gas is selling at $2.40 at Henry Hub, but they were selling it to California at $13.50 when we were in Houston. And I think they said it was 21 yesterday is what they were selling it, right, per 1,000 cubic feet, if I'm not mistaken. Now that's great. If we can make money at $2.40, we're going to make a hell of a lot of money at $21. But our economics and our pro formas can't rely on a record high to make sense. It's got to make sense at $2.40 or maybe even $3, you know, per 1,000 cubic feet. Everything else is gravy, right? And I want that. I want $50. And it's an interesting thing because, you know, when you invest in oil and gas, you don't want your gas prices to go up, but at the same time, when they do, you're making more money.
I've got a couple clients with some oil wells with some different companies. What would be some advantages? Do you connect with people that are wanting to invest in oil wells as well? So I do bookkeeping for several different farmers mainly, and a lot of them seem to have several other side things, and oil is one that some of them are into.
And so what was the question, I guess?
Okay, so like I've got some clients that do have some oil wells currently with some different companies out there. I know they've got some in Colorado and Kansas. If they find some locations that they're wanting to start looking at drilling into, is that something they could bring to you guys as well instead of the companies they're with?
Absolutely. We would have to look at, you know, how they're structured, whether they actually own the mineral rights or their working interest themselves, or if it's through a fund like what we're putting together and the fund owns it. But yeah, we would definitely, you know, we can look at those things. Something that we kind of glossed over and that I need to bring about is I'm not 100% for sure with the new bonus depreciation, but so assuming that it is 80% rule, 80% of that investment is deductible in year one, and then you get a 15% depletion deduction on every bit of income. So only 85% of the income you receive is taxable. So when we say it's the gold standard of tax benefits, it really is.
And that's what I was alluding to, and that's unique to mineral rights, correct? Anything you're extracting from the ground, that 15% deduction there's nothing else like that.
Well, and it's also an advantage of playing in the arena that we're playing in. You know, BP, Exxon, once you get over 5 million barrels a year or whatever it is, they no longer get that deduction. So, you know, riches and niches type thing.
And maybe that's the reason that 80% of our oil is produced by small companies.
Exactly.
Hey, I don't want to ask a small fish question here, but I'll just ask you guys since you're in this arena. So this is on my wife's side of the family. So my wife's grandmother and her sister owned mineral rights, and they told me it's in Noble County, Oklahoma. Well, these two sisters, they had these mineral rights passed down to them. Well, all their other families sold, but they never wanted to sell. So they've held on to it. Well, they've since passed away. So these mineral rights came down to my wife's aunt and my wife's mom. Well, they don't know what they're doing. They got paperwork sent to them. Well, I guess the end of last year, some company, I guess maybe an exploration company, has tracked them down and really is wanting to talk to them and everything like that. Well, they told them that they need to get registered to be official or whatever. So if you guys, does that make any sense to you, or what should they do? They need to talk to a lawyer down there or what?
Is it producing?
I don't know that. I haven't asked that much questions about it.
Okay. Normally when mineral rights change hands, you got to go through, and I believe it's just like recording a deed, you know, at the county courthouse, but you'll have to contact all those companies and say, hey, just so you know, the check needs to come to us. But we can definitely get them in touch with somebody that can get them a lot firmer answer than I can. Most of my interest, or most of my knowledge, is in the working interest arena. And as far as actually owning the mineral rights themselves, that I don't have a lot of knowledge in.
Okay, that's fair. I just thought I'd ask just in case.
But we would purchase them for what, $100, and we'll just deal with it.
Okay, yeah.
And we've got contacts. If you want something, by all means, I'll send you all the people that we have to help guide you on that process.
Gotcha. All right, appreciate it.
A lot of ways to skin the cat and make money in this, just like real estate, right? Once you find your niche and you exploit it. So what else we got?
Do you guys invest in coal as well?
Not currently. I would like to. Cole's had a hell of a run. I think it's knocking out all-time highs right now, which probably means the underlying asset is bringing a premium. So that would be my only concern with it right now.
Yeah, so we'll sell short on that one.
we would like to buy cheap.
Yep. Well, there's not any more questions. I appreciate y'all's time. If you have questions, go to the website, investfig.com, at least get on the email list, right? And if you decide to do something or not, or maybe you sit on the email list for a year as we keep, sending you material and information, maybe someday you'll want to invest. But I want you to do it now. So if you want to run the check, my name is on the bottom of my screen. Just feel free to write it to that. Or FIG, FIG, Fundamental Investment Grade. We'll take it too. But once we get a deal, and I'd say we'll probably realistically, we had 4 when we came back from Houston, 4 or 5. And the one we kind of focused on because it looked the best. And we kind of put the other ones on the back burner. And so we opened those doors yesterday to try and get, it's a complicated process. You have to get confidentiality agreements and all kinds of stuff just to get information to analyze the deal. And so we've got the rest of them coming on, and we've got one other one that we looked at last night. But sounds like we're probably going to revisit the gas one in New Mexico probably. But once we get those deals, the gas one was wanting money by June or July, right? They wanted to start drilling that first one in July, I think.
That's correct.
So they're either going to be real quick or it'll be a year from now. But we're get your name on the list, and once we get those analyzed and updated and decide on what we're going to do, then we'll. And
we send some content out. Like Jeff said, I kind of nerd out on macroeconomic stuff, so I'll write some pieces and send that out. Or we even, for us, we're agnostic. When the data changes, we're going to change. At the moment, this is where we see some alpha, and as soon as that changes, we'll pivot to something else. And that is, I think, one advantage of what we're doing. We're data driven.
Yeah, makes it easy to pivot.
There's your contact info in the chat if you guys want it.
And really appreciate, like I said, Chris and Levi inviting us on here and, giving us a platform to speak. And hopefully we'll see you all at the next meeting.
Absolutely. March 7th, 6 p.m.
We'll be there.
Look forward to it,
guys. Well, thank you. We appreciate you guys coming on today.
Thank you, guys.
Well, yep. Thank you.
Yeah.
Absolutely.
Have a good day.
You too.
Take care, guys.
All right.
Bye bye.
See ya.